Gene Frieda, Pimco global strategist. Gene, great to have you with us today. So it feels like we're in a little bit of a holding pattern as we head towards March and we're taking stock. Is the next move from the Fed more likely to be a rate hike or a cut from here?
I mean, I think our view would probably be more likely a rate hike than a rate cut, but I think that's what the Fed told you. They're basically data dependent. You know, they feel like policy is appropriate for what we know today. We're near something that they view to be around neutral, and it really depends on the evolution of the data. You know, if you look at the data, one would presume that it probably is going to soften a little bit from here, given the shutdown, you know, given the impact of higher rates on interest rate sensitive parts of the economy. So I think from that perspective, you know, the bar for a hike is somewhat high.
Have we seen the best of the equity market rally then that we've seen at the start of this year?
Yeah, I mean, I would say we've seen the easy part of the recovery. You know, it was, as you know, it was the strongest January in decades. But still, interestingly, if you look on a year-on-year basis, the equity market, commodity markets, a number of markets still look like they're priced for a recession. So from that perspective, you have to say that there's still some upside just on the Fed pause alone.
Just published, Gene Frieda. Bill Dudley, formerly with Goldman Sachs, formerly the head of the New York Federal Reserve, in a Bloomberg opinion piece. Folks, this came out moments ago. You'll see it out on Bloomberg.com in a bit. We give it to you first. Stop worrying about the Fed's balance sheet. What will the Federal Reserve do with all the fixed income securities it purchased? That's the worry. Mr. Dudley says, I'm amazed and baffled at the worry. The new news here is simply that the Fed sees greater demand for reserves than it expected a year ago. Last week's announcements do not have significant implications for the interest rate outlook. Market participants would be better off focusing on the economic outlook. Gene Frieda, we've heard this management of the message by current and former Fed members as well. Why is the market in so much disagreement with Mr. Powell, with the European Central Bank, with the Bank of Japan on the balance sheet?
Well, I mean, I'd have to say I agree with Bill Dudley on this, but you know, the point is the impact of quantitative easing, or as some people call it, quantitative tightening, on financial markets is very unclear, and what you don't understand, you generally fear. So from that perspective, you know, I think people have naturally been worried about the impact of some withdrawal of liquidity, you know, and the Fed has responded to it, and the market's been quite happy about it.
In the spirit of Ben Bernanke, who has told me that he's not concerned about this, and what we see from Bill Dudley with Bloomberg Opinion, isn't their advantage the X-axis, and that they can bring the balance sheet down over a timeline that market participants aren't focused on?
I mean, without question, I think that's, you know, that's the first signal that you got last week from the Fed. I mean, but again, you know, most Fed watchers would tell you that the impact of this is equivalent to a very marginal tightening in Fed funds, so it shouldn't really be having much of an impact. It's really about signaling. You know, is the Fed continuing to tighten, or is the Fed basically going to neutral? And from that perspective, whether it's rates or the balance sheet, the market takes a certain amount of solace. I agree with Bill Dudley. I mean, you know, if you look at the impact on the balance sheet estimates from an earlier end, from a quantitative perspective, like looking at G4 central bank balance sheets, it really didn't make one, you know, it makes very little difference at all. But again, it's a messaging of, okay, we feel like we're appropriate, we don't need to continue to tighten, we're not going to suck liquidity. In an environment where growth is weak everywhere, that's a really important message.
So if what I'm hearing is correct, you're saying it's more about whether the messaging is of a dovish or a hawkish Fed overall, rather than the market focusing too much on the intricacies of the balance sheet. In that sense, then, have we walked into a place of complacency at the start of this year? Is there a risk of much higher volatility further down the line because we have had this pause from the Fed?
Yeah, I mean, I think, you know, our view is that there is still some complacency in the market, albeit less than there was a quarter ago. But against that, you know, you have to take what the Fed has said, which is basically that if inflation is low, if financial stability risks are low, i.e. we don't see major imbalances, then we can manage to the left tail. We can focus on, you know, the left tail risks. So inevitably there will be discussion about a Powell put that's in place. Now, the Fed hasn't really elaborated or elucidated how they're changing their framework. So there is scope for misinterpretation. And if you're thinking, where does volatility come from? It's that risk of communication error.